Hello everyone, my name is Manoj Agarwal. I'm the group editor at Banking Frontiers magazine. Today I have with me a very interesting personality, Mr. Sameer Narang. He's the Chief Economist and he's also the head of strategy planning at Bank of Baroda. Welcome, Sameer.
Thank you. Thank you, Manoj.
So today we're going to talk about economics, the theory and the applications of that. And I have a set of questions for Sameer. But Sameer, before we get into it, can you give us a little background about yourself?
Yeah, thank you for the introduction. As a brief introduction from my side, I have over 15 years of experience in the financial markets and economics. I started my career after Delhi School with the Confederation of Indian Industry. Then I worked with the leading economist for 5 years. I did my master's after that, master's in business administration from Indian School of Business, Hyderabad. And since then, I have been working with financial institutions such as HDFC, IDFC, and now at Bank of Baroda, where I'm the chief economist.
Okay, that's great. Thank you. What new data has been provided by the government, by regulators, by any other kind of organization that has proved to be immensely useful during the lockdown for a chief economist?
Yes. So I think the biggest change from a data standpoint actually came from the mobility indicators that are provided by Google and Apple. So, these indicators actually tell you, and they break it down by, say, workplace, by recreation, by parks. So what you get actually is an immense understanding of mobility. What are people doing? Are they sitting at home? Are they going to retail places for buying groceries, or they are going out to parks, or are they going to their workplaces? So what are people doing? So it becomes a very, very important, incisive instrument for public policy and analysis as to where people are congregating, because the biggest challenge in the pandemic was to ensure that there is social distancing. And this data actually provides you insights into where people are congregating, aggregating, and how they are dispersed right now. At the same time, this data also tells you, because a large amount of economic activity is contact intensive, where people come together and meet each other. So meetings could work virtually, but restaurants cannot provide you food virtually, right? You cannot be in a meeting and eating virtual food, correct? So that food has to be delivered to you. And you cannot go and dine in a restaurant. So that mobility indicator tells you actually that, okay, so restaurants, there is not much activity happening. So it also gives you public policy or fiscal policy intervention. So perhaps in Europe and in America, the reasons why they made out certain fiscal initiatives were essentially ingrained in the mobility indicators, when you realize that restaurants are not functional, so they require certain incentives, or the workforce requires certain paychecks for them to be on a particular, for the restaurants to put them on a payroll, or to ensure that their jobs are sustained, but the money is coming out of the government's pocket rather than the owner's pocket, so that jobs are sustained. So all of this became actually very important globally as well as in India. The government also, and RBI also, took a number of initiatives. And in terms of data, I believe the government of India provided actually much more timely data in terms of how the logistics movement is happening, how the export import are happening. So the data now actually comes in the first week of the month itself, rather than to wait for the second or third week of the month. Similarly, periodically the government provided the railways logistics data. So all of that actually adds up and gives you a much better flavor of where the economy is.
Interesting. Since you talked about personal data and mobility data, are those kinds of data already ingrained in the economic models?
So we had to add those indicators to our economic. So we actually created a weekly economic tracker, given the data that comes out from mobility indicators and some of the data points given by the government, such as GST e-way bills, or the way railway freight is moving, how electricity data comes out actually on a daily basis in terms of India. So we can aggregate all of that and produce an index of how economic activity is panning out.
So what kind of insights are you presenting to your management relating to the crisis management and to recovery of the business and economy?
Correct, absolutely. So as we spoke about the in the earlier section about creating say a proxy for the economy as to how the economic activity is panning out, which segments of the economy are showing improvement in activity and which are not. So you pick up the wide indicators and actually you break them down into different segments, and you also track what's happening in the overall macroeconomy in terms of which segments of loans are growing, which segments of loans are not growing, which whether it's rural or urban, within rural, which parts of the economy have been hit harder and which have not. So it's and see, the pandemic has not impacted everybody at the same level or pace. For instance, within the rural economy, the land owning class or the landowners have had it fairly all right, simply because of the fact that monsoons have been all right, pricing has held up, food inflation has been relatively high, government procurement has been significantly higher, and government has given exceptionally high food subsidies and cleared out all the earlier arrears. And in fact, in Punjab and Haryana now the DBTs have started. So the payment is directly going into the account of the farmer. So a lot of initiatives have been taken.
So that apart from all the economic and scientific theory, have there been occasions where gut feel and economic theory have diverged? And if so, was there some, whether as an economist or whether for business heads? And then how did you rationalize it?
Oh, yes, it did. A very interesting question, very interesting question. So, for instance, the biggest question as we entered the pandemic was that where would there be lower inflation or would there be higher inflation?
Okay.
Right? Because a pandemic as such is a deflationary, event in our economic models, right? Why? Simply because people are not going out, they're not spending. So ideally inflation should come down.
Right.
Right? Because there's not enough demand for services and for goods. At the same time, people, since they are not consuming services, they are consuming more goods. So would that lead to price increase or not? That is the second question. And the third part is what happens if central banks go out and just open the currency chest?
Correct.
They go out, they go all the way out and do a full blown quantitative easing, which is coordinated not only in America, Europe, but across emerging markets and Asia, right? So what we saw was in all the three cases, you may get a different, result in terms of what your interpretation is. So that, tests your economic theory and the practicality as to how things will pan out. Added to that is the fact that when you have a lockdown by the government, the demand is it, but also is the supply, because the supply of perishables will not be available in the market. So interestingly, so you have to take a call, and by the way, inflation data is not going to come because the government and the CSO was not able to do the survey in that month of April and May. Yeah. So you have a lot of, a really challenging, environment in front of you, and how do you predict, right? So that is when your economic theory and the practice is, tested. From an economics or economist standpoint, I would say that those are very interesting times.
Very interesting. That gut feel also, in the absence of data, gut feel was able to do a good job in understanding the situation on the ground. Let me go back a little into some theoretical aspects.
Right.
Every professional has learned something new because of the pandemic and lockdown, because of the crisis created by the pandemic and lockdown. So my question is this: have economists learned something new? Because this is that one of those rare situations that happens once in a century. Has then some learning been coming out of this? New learning?
I would say yes. Because if you look at what happened after the 2008 crisis, the Federal Reserve and the ECB all, went into quantitative easing to provide liquidity to the markets, and then the economies pulled back. But they were very quick in reverting back their quantitative easing policies, because they feared that the asset inflation which is being created may, lead to higher inflationary expectations in the long run. After the pandemic, that is being put into test now. The ECB has changed its strategic framework. it's all right. It's okay with having a slightly higher period of higher inflation, longer period of higher inflation,
Okay.
but wants to ensure that people who have lost jobs in the pandemic do get it back. So central banks globally, and I think in India, where we have an average inflation target of 4%, we've been running it higher than that for this year. This year is going to be higher than that. Last year was higher than that. So you're going to be, and next year also perhaps. So you're going to see a period of 2 to 3 years when inflation is actually going to be higher than what your target is. But you're willing to live with it in order to ensure that growth comes back. And globally, I think that mandate has changed, which is a new learning. Because earlier, when we saw after the 2008 crisis, the central banks did pull back in the taper tantrum in 2013, and there was impact on global markets. Now, I think the new thinking, which is coming from an economist standpoint, is that we are okay to live with a little bit of extra inflation, but to ensure that the jobs that have been lost by the pandemic, they actually come back as a matter of public policy. So I think the thinking has changed also on the fiscal context that earlier the theory that played out was that you don't want so much of debt to GDP because it's very difficult to inflate your economy beyond a point. But now, if you look at governments, they are very comfortable in terms of fiscal expansion as well and lower interest rates. So I think there has been a change in the thinking and thought process globally as well as in India.
So has this been accepted by our most leading economists, this new rebalancing between jobs and growth and inflation? Or are there contrarian views?
See, as you have correctly hit the nail, the head on the nail, is that yes, there are always contrary views, right? So if you look at the US Fed, the FOMC board, so there are members who support this, there are members who believe inflation is going to go up, so you need to quickly rein in the quantitative stimulus that one is giving. So there are always good to have views and counter views. But my sense is that from a public policy standpoint, there has been some understanding that this requires a recalibration from what we did right from the Volcker years of beginning of 1980 when he actually raised interest rates to a record high to break the back of inflation in the US. So there has been a large movement from that extent context, and now we are seeing a different public policy from that perspective. So we need to be more prepared, and we need to invest in technology to be more green. We need to have carbon pricing models. So I think overall the pandemic has led to, I think, a leapfrog in terms of digitization of human activity on planet, and all of these things will have a lot of impact on the way public policy is implemented in the coming few years.
So what I understand you're saying is a lot more data is being generated, and that helps economists create more precise models and better forecasts. And in that sense, perhaps you're saying that economists have lesser divergence of views than they had maybe 10, 20, 30 years ago. Do you think that this crisis will create some Nobel Prize winners? Some economists will analyze this, and maybe that will become some kind of Nobel Prize coming out of COVID analysis.
It is possible. If you see the last Nobel Prize came out for reduction in poverty and how that application has been done in terms of inequality. So this will have deeper repercussions on inequality because there are, look at the economic recovery, be it in the US or emerging markets. The informal sector has suffered much more than the formal sector. So inequalities have risen. And this can obviously, have very deep reaching consequences for public policy in the coming few years and decades. Because what we gained, we've lost a little bit of that in the last 12 to 18. So what should be the way forward? What is the right public policy in such situations? What is the right central bank policy, and how global inflation, growth, and economic momentum and inequality is going to pan out will obviously create opportunities for research as well as public policy and direction, which can itself be a Nobel-winning thesis or piece of work.
Well, we look forward to that. On the note, Sameer, thank you very much for your insights, for being part of this Banking Frontiers initiative.
Thank you, Manoj, and all the best to you. And as always, a pleasure interacting with you.